When we talk about bubbles in the housing market, we're really talking about situations where home prices rise far faster than the fundamentals that support them, like income levels, employment stability, and population growth. And right now, Nevada, especially cities like Las Vegas and Reno, is showing all the classic warning signs. The first red flag is rapid price growth. Over the past few years, Nevada home values have surged at rates that outpace wage growth by a wide margin. While household incomes in Nevada may have gone up 5 to 10% in recent years, housing prices in some areas have doubled. That gap between what people earn and what homes cost is unsustainable. It means more and more residents are being locked out of ownership. The second sign is rent escalation. Rents in Nevada have skyrocketed, particularly in Las Vegas, where landlords are charging record highs. This isn't just a problem for renters. It also signals that speculative demand, not just genuine housing need, is driving the market. Investors see rising rents as an opportunity, and they pile in, making the problem worse. Which leads us to the third warning sign: heavy investor activity. Wall Street firms like Blackstone, along with smaller corporate landlords, have been buying Nevada homes in bulk. Their goal isn't to help families own property. It's to turn those homes into long-term rental cash machines. When investors dominate the market, housing becomes a financial product rather than a basic need, which increases volatility. If prices fall, they can simply pull out, leaving ordinary buyers and renters stuck with the fallout. The fourth and final signal is overconfidence. You'll hear people say things like Las Vegas housing always goes up, or Nevada is bulletproof because everyone wants to move here. These kinds of statements were common right before the 2008 crash. Overconfidence creates a dangerous feedback loop where buyers stretch themselves too thin, convinced that prices can never fall. History shows us they can, and when they do, it happens fast. Taken together, these signs point to a Nevada housing market walking on a razor's edge. Prices can't keep outpacing incomes forever. The question isn't if the bubble pops, it's when and who gets hurt first. Nevada's housing market isn't just expensive, it's becoming fundamentally unaffordable for the very people who live and work there. What we're seeing in 2026 is a growing divide between local incomes and the cost of keeping a roof overhead, and it's hitting families harder than ever before. Let's start with homeownership. For decades, Nevada was seen as a place where middle-class families could buy a starter home without drowning in debt. But today, in cities like Las Vegas and Reno, the median home price has climbed so high that the average household income simply can't keep up. Mortgage payments are consuming bigger chunks of people's paychecks, leaving little room for savings or emergencies. For many first-time buyers, the dream of owning a home is slipping further out of reach. Now let's talk about renters, because the crisis doesn't stop at ownership. Rents across Nevada have surged dramatically, often rising faster than wages. In some neighborhoods, rent has jumped by 20% or more in just a couple of years. For working-class families, that means making tough choices, cutting back on essentials, picking up second jobs, or living with multiple roommates just to cover the basics. The squeeze is real, and it's forcing people out of the communities they called home for years. The affordability crisis also creates social and economic ripple effects. Teachers, nurses, service workers, and other essential employees, the backbone of Nevada's economy, are finding it harder to live near where they work. That means longer commutes, higher transportation costs, and ultimately, burnout. When housing pushes essential workers away, entire communities suffer. What makes things worse is that corporate investors and developers are capitalizing on this situation. Instead of building affordable housing, much of the new construction is aimed at luxury buyers or rental properties designed to maximize profits. The result? More supply at the high end, but very little relief for everyday families. In short, Nevada is facing a full-blown affordability crisis. It's not just about expensive homes. It's about a system that increasingly shuts out the middle and working class. If wages don't catch up and housing supply doesn't shift toward affordability, the divide will only deepen, and Nevada could face not just a housing crunch, but a housing collapse. One of the biggest forces reshaping Nevada's housing market isn't families looking for homes. It's investors, both big and small. And their influence is one of the main reasons the market feels so unstable right now. Let's start with the big players. Wall Street firms like Blackstone and other private equity groups have been aggressively buying up homes in Nevada, especially in Las Vegas and Reno. Instead of selling these homes back to families, they're converting them into long-term rentals. On paper, this looks like smart business, stable rental income, and rising property values. But for ordinary buyers, it means there's less inventory available, and the homes that do hit the market are priced higher because demand is being artificially inflated. Then there are the smaller investors, flippers, and out-of-state buyers who see Nevada real estate as an easy profit. Many scoop up cheaper homes, make minimal upgrades, and then sell them at much higher prices. This drives up neighborhood values and makes it even harder for locals to compete. It's not that flipping is new, but when it happens on a large scale across a state already facing a housing crunch, it turns homes into commodities rather than places to live. The rise of institutional landlords is another concern. Families that might have been able to buy a home 10 years ago are now finding themselves as long-term tenants paying rent to corporate owners. And unlike a local landlord, corporate ownership often means stricter leases, less flexibility, and higher annual rent increases. All of this creates a dangerous feedback loop. Investors see rising prices and jump in. Their purchases drive prices even higher, attracting more investors. Meanwhile, local buyers are pushed to the sidelines. If the market stalls or mortgage rates spike, these same investors can quickly sell off properties, flooding the market and causing prices to collapse. Ordinary homeowners, however, don't have that luxury. They're left holding the bag. In Nevada, the investor factor has tipped the scales. Housing is no longer just shelter. It's an asset class, a money-making tool for those who already have wealth. And while investors profit, everyday Nevadans are left asking a painful question. Will there ever be a fair chance to own a home again? Every housing boom eventually faces the same question: what happens when the music stops? In Nevada, the warning signs suggest that sharp correction, or even a collapse, could be closer than many people want to admit. The first risk comes from high mortgage rates. Over the last few years, interest rates have climbed significantly, and while prices kept rising, fewer and fewer buyers could actually qualify for loans. In Nevada, where wages haven't kept up with housing costs, the strain is even worse. If rates stay high, buyers will continue to drop out of the market. And when demand falls, prices follow. Another looming threat is over-leveraging. Many buyers stretch themselves thin just to get into homes during the boom, often taking on massive mortgages compared to their income. That works as long as the market keeps climbing. But if property values dip even slightly, some homeowners could find themselves underwater, owing more on their mortgage than their home is worth. That's exactly what triggered foreclosures during the 2008 crash, and Nevada was one of the hardest-hit states back then. There's also the issue of investor-driven volatility. As we've discussed, big firms and flippers have snapped up properties across Las Vegas and Reno. If prices show signs of slipping, these investors won't wait around. They'll start selling off en masse. And once that wave of listings floods the market, prices could fall even faster. Unlike families who plan to live in their homes for years, investors treat housing as a trade, and they exit quickly when the profits disappear. Finally, the psychological factor can't be ignored. Housing markets run on confidence. Right now, many Nevadans are already whispering about a bubble. If enough people believe the market is unsustainable, they'll hesitate to buy, banks will tighten lending, and sellers will cut prices to attract interest. That shift in sentiment alone can trigger the downward spiral. In short, Nevada is walking a tightrope. Prices are at record highs, but the foundation beneath them, income levels, interest rates, and real demand, looks shaky. All it takes is one spark, whether it's a rate hike, an investor pullout, or a wave of job losses, to turn today's housing boom into tomorrow's housing bust. And history shows, when Nevada's housing market falls, it falls hard. Nevada's housing market today sits at a crossroads. After years of explosive growth, sky-high prices, and a flood of investor activity, the question on everyone's mind is simple. Where does it go from here? The future of Nevada housing could take multiple paths, and each one carries big implications for buyers, renters, and investors alike. One possible scenario is stabilization. If mortgage rates level off and new housing supply enters the market, prices could finally cool without completely crashing. In this case, home values may grow slowly, giving incomes a chance to catch up. For buyers, this would mean a more balanced market, though affordability would still be a challenge in hotspots like Las Vegas and Reno. But there's also the risk of a sharp correction. Nevada's market has grown at an unsustainable pace, and history shows that booms often end with busts. A wave of investor sell-offs, combined with stretched buyers defaulting on loans, could push prices downward quickly. This scenario mirrors the 2008 crash, when Nevada became one of the hardest-hit states. If that repeats, the market could take years to recover. Another path forward is continued inequality. Even if prices don't collapse, the affordability gap may widen. Corporate investors may hold onto their rental portfolios, keeping homeownership out of reach for many locals. That could transform Nevada into a renter-majority state, with more families locked out of ownership permanently. For communities, that means less stability, as families move frequently and wealth-building opportunities vanish. Of course, there's also the role of policy and development. If state leaders push for more affordable housing projects, zoning reforms, and limits on corporate ownership, Nevada could see a healthier housing market in the long term. But without those interventions, the imbalance between wages and housing costs may persist. So what does the future hold? The truth is, Nevada's housing market is at a tipping point. Whether it stabilizes, crashes, or transforms into an investor's playground depends on interest rates, economic conditions, and policy decisions in the next few years. For everyday Nevadans, the best move is to stay informed, plan carefully, and avoid the overconfidence that fueled past crashes. Because one thing is certain, the story of Nevada housing is far from over.